A very good afternoon to you. Let's take a look at the markets. Asian markets opened in negative territory as oil prices rose over 2% to register a 5-month high following the US's strike against Iran's nuclear facilities over the weekend. But at the close, some bourses closed in negative territory while others closed in positive territory. This as the Brent crude oil price retreated to below $78 a barrel. But investor nerves remain strained as the ball is said to be in Iran's court as it decides how it's going to retaliate against the United States, with talks of it considering closing a major waterway that could disrupt crude oil shipments. The Nikkei share average declined by 0.13%. The Hang Seng Index gained 0.67%, while the Shanghai Composite Index rose by 0.65%. Well, of course, before the weekend on Friday, U.S. stocks ended the week on a subdued note as market players saw increased risks of heightened tensions in the Middle East, uncertain as to whether the United States would enter the Israel-Iran fray. As it turned out, the fears were spot on as the U.S. did decide to attack Iran's nuclear power facilities in 3 different locations over the weekend. The futures market suggests that U.S. markets will open slightly in the red. Well, on Friday, the Dow Jones Industrial Average rose by a mere 0.08%. The S&P 500 declined by 0.22%, while the Nasdaq Composite Index fell by just over 0.5%. Looking at local indicators now, the All-Share Index is up 0.3% at 94,992 index points. The Rand is trading at 18.09 against the US dollar, 20.75 vis-a-vis the euro and 24.21 against the British pound. Gold is trading at $3,366 an ounce, platinum at $1,287 an ounce, while Brent crude oil is trading at $77.35 a barrel. All right, let's get into conversation with Gary Boyson. He's a portfolio manager at Rand Swiss. Thanks very much, Gary. So what's your reading of how markets are performing in light of the military maneuvers that we saw in the Middle East over the weekend?
Yeah, I think the market is taking it in its stride. I was actually surprised by just how subdued the market reaction was. It's to be expected to see the oil price a little bit weaker. So, we did obviously touch that $80 a barrel and pull back. But it does seem like if you look over the medium term, short of closing something like the Straits of Hormuz, the oil market will be well supplied. And what we've seen really is an escalation in the risk premium if you compare the output to growth expectations. So, $78 a barrel, it's obviously building in the risk premium. But, if we weren't seeing a conflict in the Middle East, that would be significantly lower. Looking at our local currency, we're out at 18.14 to the dollar. We've seen a little bit of a pickup in the US dollar index, but we are losing a ground against the euro and the pound as well. And that's also to be expected. When you see heightened geopolitical risk, of course, you see a flight to safety and you see typically money pulling out of emerging markets like South Africa. So that move also does make sense, although it is fairly subdued. We've seen, call it 10 cents on the local currency, which is really not big given the historical moves that we see in the Rand.
Yeah, I suppose, to the point that you were making around the possibility of them deciding to close the Strait of Hormuz, that hasn't happened. And I think because this is an evolving story, should that happen, then I suppose we would then see a very sharp increase in oil prices. And also as well, we've heard that the Houthis, the Yemeni people, have said that they'd be willing to obstruct, movement on the Red Sea and so on. So this could happen all of a sudden. And I guess it's only then that we'd see a sharp increase in crude oil.
Absolutely. It's a very binary event. So it's either going to happen or it isn't going to happen. And, if you just consider the importance of the straits, they're 21 miles wide at their narrowest point. And, if you look at the volume of global oil trade that moves through there, it's around a quarter. You're talking about 20 million barrels per day. So it's around 20% of the liquefied natural gas market as well. So an absolutely critical choke point for energy. And I think the challenge around, Iran targeting the the Straits of Hormuz is that it's also the bulk of that trade goes to China, which is a country that's come out and condemned, obviously, the US bombings over the weekend, and I suppose does at this stage serve as a lever to generate support for Iran in China. So, I've seen people have talked about it being suicidal for them to close the straits, and certainly I don't think the market is pricing that in at all. Historically, we've seen Iran has been a lot more controlled in its responses, and if they were to close the straits, to your point, I would easily see Brent crude oil above $100 a barrel almost instantly.
Yeah, no, that's crazy. I mean, perhaps this is not really a markets question per se, but you talk about it being suicidal for them to close the Strait of Hormuz, but they have to do something according to apparently their psyche. From what I've been hearing from analysts, the Iranians are not just going to fold their hands. So it's either that or go down the military route. But if they do that, I suppose the US would pulverize them in response.
Oh, well, if you look at the official White House line, I suppose it has really been about the weapons of mass destruction. It's been about the Iranian nuclear program, although they were obviously members of the NPT as well. So, looking at it, we've obviously had Donald Trump on Truth Social, hinting at regime change as well. And I think there's a good chance that the US gets involved either way. And as I said, we kind of go on the historical reactions that we've seen from Iran, and it has been very controlled from their side. But it is a moving target. It's an incredibly dynamic story at this stage. And I think the real question for traders, I suppose, if you are in the oil markets, is this risk premium high enough at this stage? Because, as you say, a very binary event, but we hope that sanity prevails.
Yeah. So then how does all of this stuff that we're talking about then translate for the South African economy, for South African markets?
Well, if we were seeing oil above $100 a barrel, so if the conflict really does escalate, I mean, you can say goodbye to our inflation targeting framework. We'll see massive inflation locally, and a very likely chance that South Africa moves into recession. We're an oil importer, and of course, it's going to have an upward pressure on prices. So even with this, when I say small, relatively small move that we've seen so far, before we really started seeing tensions ratcheting up, oil was trading around, let's call it $65, $67 a barrel. We're at $78 a barrel now. That's already building in around a 50-cent increase into the petrol price for next month. And of course, fuel price increases, they ripple throughout the economy. They move into the cost of every good that you buy, from the food that you get in shops to the goods that you purchase at any retailer. So absolutely, higher oil prices are going to cause significant economic pain for South Africa. But as I said, let's hope sanity prevails, and we see negotiations reopening and a cooling off of what has been a very hot weekend.
Yeah, no, I was going to say the exact same expression. Let's hope that sanity prevails. Thank you so much, Gary, for your time and insights as always. That was Gary Boyson. He's a portfolio manager at Rand Swiss.